Well, welcome everyone. Thanks very much for coming along. It's really great to see such a great turnout. My name's Laurie Macfarlane. I'm co-director at Future Economy Scotland. We're a think tank focused on creating a new economy for Scotland that's democratic, sustainable, and just. So I'm joined today by my colleague Hanna Wheatley, who's our senior economist, who you'll hear more from shortly in the presentation. But Hanna, do you want to just say hi to everyone briefly?
Yeah, hi. It's great to be here and excited to present to you today.
Okay, so over the course of the next hour, we're going to present, but also hear feedback from you folks and questions, the findings of one of our recent reports, Restoring Nature to Deliver a Just Transition. And this report really looks at the challenge of scaling up investment in nature restoration to advance Scotland's wider climate and nature goals. And when doing this report, we were conscious that it's quite a long and dense report on what is inherently quite a thorny issue. And we know it's an issue that many people care deeply about, as we do. And so we thought it might be useful to do a session where we both talk through the report and its findings in an interactive format, because although we've now published this report, we're really keen to hear from others in terms of sort of feedback, in terms of questions that people have, thoughts, etc. And we're definitely not saying that what we've done in this report is the definitive right answer. Far from it, in fact. Instead, we just hope it's a useful contribution to the debate. And no doubt there are others out there, including on the call, with expertise and experience in these issues, which we're really keen to hear and learn from. And so we really look forward to hearing people's questions and comments, and we'll make sure we'll leave plenty of time for that. So in terms of structure for the next hour, so I will kick off by discussing the kind of challenge that we face here. So this will cover some of the context surrounding Scotland's nature challenge, but also some of the issues around the economics of nature, which makes it quite a difficult issue to address. I'll then hand over to Hanna, who will present the key findings of the report's analysis and modelling, and also talk through our main key recommendations. We'll then open up to a wider Q&A discussion where we'll aim to answer questions, but also hear your comments. And as we go through the presentation, please do make a note of any questions that you want to ask. You'll see that we have a Q&A box at the bottom. If we can ask if you can hold off until we enter the sort of question discussion bit of the session before you actually post the questions in the box, rather than during the presentation, because this will just make sure that we don't miss them. And so if you just make a note of them, and then when we get to that point, feel free to drop them in. And as I say, we're aiming to leave, around half the time that we've got for that discussion. So we hope to get through as many as possible. Okay, so to kick things off then on the challenge. So as I'm sure we all know, Scotland has ambitious both net zero and just transition ambitions. And according to the Climate Change Committee's most recent balanced pathway, land-based actions are due to account for around 8% of emissions reduction by 2035, rising to 13% by 2045, with woodland creation and peatland restoration doing much of the heavy lifting there. We also saw Scotland's new draft climate change plan come out very recently, which also recognises the really crucial role that woodlands and peatlands have to play in Scotland's net zero journey. And it's important just to note up front that the terms nature and nature restoration obviously encompasses a really wide range of things in terms of woodlands, peatlands, but also different forms of ecosystems and habitats. The report that we've done specifically focuses on the role of woodlands and peatlands. And that's not because they're the only important thing. It's just that that was the sort of scope of our report. So when we're referring to nature in the presentation, we're generally referring to woodlands and peatlands, but we will try and be specific. When we look at our record on delivery, though, what we see is that we're falling quite significantly behind our targets. So firstly, in relation to woodlands, the Scottish Government set a target of increasing national woodland cover to 21% of land area by 2032. Equates to an increase of around 200,000 hectares. Now, in order to meet this, targets of afforestation were set to rise incrementally between 2021 and 24-25, although the recent climate change plan has changed things slightly. As you can see from the chart here, though, we see that planting's fallen short of targets in every year. And despite promising increases in 23-24, planting then fell again significantly in 24-25, which wasn't helped by a significant cut to the forestry grant scheme in the Scottish budget. When we look at peatlands, though, the outlook is even more stark. So back in 2018, the Scottish Government set a target to restore 250,000 hectares of degraded peatlands by 2030. And this was followed by a pledge to invest £250 million over 10 years towards achieving this. As shown again in the chart here, though, between 2018 and 2023, average restoration averaged just around under 6,000 hectares. And although we did see a record high hectares restored in 24-25, this would really need to kind of roughly double every year to meet that target. And again, we saw the climate change plan here come out recently, which proposed new targets, but the broad picture remains the same. And so with this research, what we wanted to ask really is why are we falling so far short of targets? And what are the issues here? And so we look at both financial barriers and non-financial barriers, both of which are equally important. And so we'll turn to financial barriers first, but then I'll hand over to Hanna in a bit, who will also cover some of the crucial non-financial barriers. So why financial barriers? What do we actually mean? Well, restoring nature obviously requires investment and that needs to be funded. So in other words, restoring nature costs money. And one of the key questions is how much money is needed. And this has been an area that's attracted a lot of debate with various figures for the so-called nature finance gap have emerged and have played quite an important role shaping the discussion. A number of years ago, there was quite a notable report by the Green Finance Institute, which reported that the nature finance gap for Scotland was 20 billion overall, of which around 9 billion was related to activities like peatlands and woodlands. On an annualized basis, this equates to just shy of a billion a year, which is shown on the chart here on the left-hand side. Now, this 20 billion figure was quite influential. It was cited frequently by government, by policymakers, and particularly in relation to the need for private finance to come in. Because given the very challenging public finances, that 20 billion is obviously a very large sum and would be too much for the public purse to bear alone. Since then, though, that figure's come under some criticism by Community Land Scotland, the Forestry Policy Group, and ourselves, among others. And I think it's fairly widely accepted now that that 20 billion figure and the 9 billion was quite a significant overestimation. And so we're very clear that more investment is absolutely needed, and we need to be clear on that. There is a funding issue, but we do need to have a clear sense of scale and proportion. And in our report, our analysis finds that the funding shortfall to meet Scotland's peatland and woodland targets, we find that in the range between sort of 40 million and just under 180 million pounds per year. Now, this is obviously not to be sniffed at. It's still significant, but in public finance terms, it's really quite small in terms of the overall government budget. It's about 0.1% to 0.3% of the total Scottish government budget. And so, recognizing the challenging fiscal outlook and the scale of the overall public finances, that's not beyond the realm of possibility if we really care about meeting these targets. And I think the key point here, just to stress, is that we're certainly not saying that our analysis here is the correct, precise gap or figure to the pound. There's more work needed here. It's instead just to highlight that the sense of scale and proportion that we're talking about is significantly lower than other figures that have played a key role shaping the debate, particularly in relation to the need for private finance. And given the issues associated with private finance that we'll come on to talk about, we argue that we need to take a step back from the assumption that private finance is the only way to do this and instead appraise other options, which we will talk through in a minute. In addition, though, when we're thinking about how best to tackle the nature issue, it's really important for us that we consider the unique economics of nature. Because when we take a step back at first glance, it might seem obvious and indeed very practical to say, actually, yes, let's just bring private finance in to deal with this. That seems like a bit of a no-brainer because we need to scale up investment in nature. The public finances are very tight. And private finance obviously funds many other aspects of our economy, from renewables to food production. So why not nature as well? And the reason this is difficult is because nature and particularly things like woodlands and peatlands are not your typical market commodities. So they have distinct economic characteristics for several reasons. The first of these is that nature is highly bound up with what in economics we call externalities. So this means that the social environmental costs and benefits aren't accounted for in market prices, which typically only value obviously what has a monetary value. And so nature produces lots of classic public goods, so things like clean air, biodiversity, flood protection, as well as carbon sequestration. but it also supports social benefits like citizen health, well-being. These wider social and environmental benefits are extremely difficult to monetize, and many of them are typically not reflected in market prices. And it's generally recognized in economics that the private markets will generally underprovide these public goods, as the incentives there aren't to invest in them. And so this is why today in Scotland, government provides grants to subsidise things like woodlands and peatlands, because without these subsidies, the investment just simply wouldn't happen. The creation of carbon credits and carbon markets was partially designed to address this, but carbon credits obviously only put a price on one thing, and that's carbon, while the range of other things I mentioned before, the social environmental benefits, are largely overlooked. And this also means that investing in nature restoration at the moment has relatively low financial returns. And obviously, in relation to private investment, and private investors are typically not charities. They will invest seeking a commercial rate of return, which in this space is often double digits. It is important to note, and we talk about this in the report, that philanthropy has and will continue to play a really, really crucial role restoring nature in Scotland. But there just simply isn't enough of it to rely on it. And so when we're talking about private finance in the context of this work, we're referring to major mainstream commercial finance as opposed to philanthropy, so institutional investors and things like that. But at the moment, carbon prices just aren't high enough in most cases to generate the kind of commercial returns that would attract investors. And if they were, we would see investment and pouring in a way that we're not at the moment. And so this challenge and these characteristics that we see on screen, and particularly the low financial returns, has led governments to start thinking about mechanisms that could help bring in private investment, and particularly around de-risking mechanisms, which generally involves the state sort of bearing some of the risk associated with it to make the returns more attractive for investors. But as Hanna will come on to talk about, the amount of de-risking required to make this work would be quite significant, and in essence involves developing quite complex, complicated, and potentially risky mechanisms that ultimately can end up pushing up costs and making things more expensive. And so overall, our conclusion is that the unique characteristics of nature really don't align well with the logic of private finance in a way that other parts of our economy do, and that some of these features are difficult to reconcile with the expectations that private investors have. And so in essence, if we're expecting to rely on private finance to fix the nature crisis, we are in some senses trying to fit a square peg in a round hole. These two things are awkward bedfellows, and trying to make them fit together, as I say, can end up being a very challenging, complicated, and potentially costly task. And I think for us, the key thing to stress here is that our view on this isn't coming from an ideological perspective. Private investment has an absolutely essential role to play in our overall net zero journey. We're simply not going to get there without it. But I think we do also need to recognise where private finance can lead, which is frankly most areas, but also where it isn't well suited and where government needs to play a more proactive role. And in our view, nature certainly is one of these areas. And if we're serious about delivering our ambition here, I think that needs to be the case. And finally, this is particularly important in the context of a just transition, because in Scotland, we're not just legally required to deliver net zero, we're also required to deliver a just transition in terms of making sure that costs and benefits are fairly shared and inequalities are tackled. And the Just Transition Commission a number of years ago published a report, which I think was quite apt in relation to the nature question. You can see on screen just now, which says part of ensuring a just transition must be about making sure the benefits of investment are felt as widely as possible. Without careful design and meaningful engagement, there is a risk that benefits may flow mainly to large landowners and opportunities for community benefit will be missed. And Hanna will come on to talk about this a bit more. But thinking about recognizing the distinction between a pure net zero approach and a just transition is really, really important. And thinking about how we are actually restoring nature and ultimately who wins and who pays. So just to wrap up before I hand over to Hanna, on the recap of the challenge, the nature has a really crucial role and growing role to play in meeting net zero. We have seen in recent years an increasing focus on turning to private finance as a means of doing that, in part because of the debate about the nature finance gap. But as we just talked about, the unique economics of nature makes it difficult to kind of reconcile the needs and expectations of private finance with nature without complex de-risking mechanisms. And so this led us to kind of take a step back and say, okay, actually, what are we actually trying to achieve? What outcomes do we want to achieve? What are the different investment models we could use? What are the costs, benefits, and risks of each? And what are the distributional consequences of that in relation to a just transition? So I'll hand over to Hanna now, who'll talk through the results of our analysis and recommendations.
Thanks, Laurie. So I'm going to talk through some of our findings, and initially I'll focus a little bit on the modelling that we did as part of the report. So I'll just talk you through what we did. We modelled the financial performance of a kind of illustrative peatland restoration project covering 100 hectares over 50 years. For this modelling section of the report, we looked specifically at peatlands because the challenge here is most significant from an economics perspective. We varied the investment model. So we looked at the current public grant system, a de-risked private finance system, which I'll talk through, and a public-led investment model. We tried to keep all the other assumptions the same so that when we're changing just the investment model, we can see some of the kind of impacts that each investment model has. And the criteria that we were using to assess them were the financial viability of the project. So does the project have a positive cash flow? If it's negative, then landowners or managers might be unlikely to proceed with the restoration. The costs to the state, so the cash cost to the government of maintaining the subsidies or financial support associated with that model. And then, as Laurie mentioned there, alignment with just transition principles. So how are the costs and benefits shared between landowners, investors, government, and communities? For that, we were drawing on sort of just transition principles and some of the ideas around community wealth building. So in terms of assumptions, we adopted most of our assumptions from a report commissioned by the Scottish Government by Finance Earth in 2023. All those assumptions are in the annex of the report, which you can have a look at. We did sort of sense check to see whether they still held in terms of sort of the costs of different things. And we have changed a couple of them, which I'll talk through at the time, but mostly they stay the same. We're not going to have time to run through the kind of whole analysis in this presentation, so I'm just going to give you a flavour, and I hope that you'll have a look at the report for more information. So in each of the models, this is an example of the cash flow model, and this is the current investment model. So we're looking at a peatland project over 50 years. The horizontal axis is time, measured first in 5-year chunks and then in 10 years. So all the bars above zero are income and the bars below zero are spending, and the yellow line is the cumulative cash flow over time. So if the yellow line goes below zero, we're in trouble. It means the project's run out of money. And just a note on costs. So capital expenditure, which in the graph is CapEx, that covers things like the upfront restoration costs, and operating costs, OpEx, which includes ongoing maintenance work like fencing and things like that. OpEx costs increase over time with inflation, which is why those bars get bigger over time. So in this example, a project gets a peatland action grant, in this example, for 100% of upfront capital costs. However, the landowner or manager has to cover the ongoing annual operating costs, which get bigger over time. So to cover those, they register with the Peatland Carbon Code, where they can either sell pending issuance units, forward-looking promises to deliver verified carbon emissions reductions, or peatland carbon units, which represent a tonne of carbon emissions that has been independently verified as being avoided emissions from a completed and validated restoration project. The Finance Earth report that we're using the assumptions of estimate that peatland carbon units, PCUs, will be worth 50% more than PIUs because of that verification. So in this example, the projects sell all of their PIUs, pending issuance units, upfront. That might not be realistic, but that kind of shows a worst case scenario. The project obviously gets a short-term surplus by doing so. They put all the money in a bank account and there's a small amount of interest there as well. But even still, after 28 years, that cash surplus runs out. There are still maintenance costs, but there's no more money. So the idea is that they probably wouldn't continue with this project. we can change this by changing the assumption about when carbon credits are sold. So here they're sold as peatland carbon units progressively over time. So which means that they sell for more, and clearly the cash flow looks significantly better. However, the Scottish Government's moving away from 100% upfront grants, in fact, already has because of affordability, and is increasingly looking toward private finance to cover the upfront costs of restoration for lots of the reasons that Laurie mentioned before. So if you look at this graph, you might think, okay, well, if we can get private finance to cover the upfront costs and there's income coming in from carbon, why not reduce the cost to the public sector and replace that upfront grant with a loan from private finance? This graph shows the result of doing just that. Now, I just want to say that this is a very simplified example. There is a question about how much private finance is brought in versus grant. We can come back to that in a moment. But this example is just 100% replacing the grant with private finance. And what you can see here is that it adds significant costs. The only difference between this and the previous slide is that the upfront grant is fully replaced with a loan, which has a 10% interest rate and is repaid over 25 years. So clearly, we've got the upfront private loan, and then underneath, we've got these new bars, which are investor repayments. And clearly, the introduction of debt is what makes this cash flow unworkable. In order for this to work, you would need a kind of meteoric rise in the price of carbon. But at the moment, neither landowners or investors are likely to be interested in this example because there's just too much risk. And that's what's led to a focus on de-risking, which aims to sort of make investing in peatland restoration less risky for investors. One example of this de-risking kind of measure comes from a paper, the one I mentioned before, commissioned by the Scottish Government by Finance Earth in 2023. And this is essentially when we talk about trying to fit a square peg into a round hole, this is kind of what we're talking about. Finance Earth designed a model to mobilise private investment into peatland restoration. And their model includes 3 different ways of de-risking. Firstly, the government is to provide seed funding for a Scotland Carbon Fund, which brings together different investors to provide loans. Then the government would also introduce a price floor guarantee where the Scottish Government would promise to buy carbon credits at a certain price, thereby protecting returns of investors. And then thirdly, the Scottish Government would continue to provide some upfront capital grant and also introduce new ongoing operating payments. Those are the striped bars in the graph. I'm not going to go into too much more detail on this, but the key point is that Finance Earth hold this up as an example of good financial governance. But the cash flows are actually quite tight. So you can see that the project makes a loss almost every year for 20 years, at which point the cumulative cash flow drops to 0 or even slightly negative in year 20 due to the need to pay investor returns. So the net cash flow at the end of the project is considerably lower than in the previous models I showed you. But there's also a couple of issues with this model. One is that there's an error where it only shows 20 years of loan repayments, where it should be 25. We'll come on to that. And the second is that they're assuming a 5% interest rate for investors. We think this is key. We think this is highly unlikely, and all of the conversations that we've had as part of this research suggest to a sort of minimum double-digit need for returns for investors. So to correct for this, in the next graph, we are showing 10%, which changes things drastically. The project is sort of financially unviable. This model increases the project cost by 48% compared to the current model. And actually, even if the 5% interest was used, it increases costs. That would increase costs by 31%. So these additional costs can only be met through larger public subsidies or by reducing the developer's profit, or a combination of both. And in practice, the model is highly unlikely to work without sort of very optimistic and, in our view, potentially unrealistic increases in carbon prices. There are other issues to this which we explore in the report. So the cost to the project, as I've said, is higher. The cost to the state is also highly dependent on carbon prices because of the price floor guarantee. So although it's possible that a de-risking model like this costs slightly less than the existing grant funding model, it's also possible that it could cost significantly more, in our modelling of 560% more. And there's just a wide range of costs associated with it. And we think that this sort of amounts to placing a large taxpayer-funded bet on carbon prices. Now, this is just an example. The Scottish government aren't taking this forward whole scale, and haven't, in the 2 years since it's been published. But they are taking forward some elements of it in a new de-risking pilot called the Carbon Contracts Pilot. So in 2025, Scottish Government launched a new pilot called Carbon Contracts, which is being administered by NatureScot. And in this model, the government will enter into carbon contracts with individual peatland projects, whereby it will give each project an option to sell a portion of the project's resulting carbon credits at a pre-agreed price and time, all of which is negotiated individually between the government and each project. Now, it's just a pilot, and obviously it's being used to assess the impact of this on funding, and in a way that contract element works as a kind of price floor guarantee, like the one we previously discussed. However, a key thing is that the way this works is that there isn't actually any additional money. So projects can choose whether they receive a certain amount of money as an upfront grant or as a carbon contract or as a mixture of both, but the actual total amount of money available to each project will be the same. As a result of that, we fail to see how it can significantly shift the dial, and we don't really think it's scalable, as for many projects, this won't really significantly shift the dial. It might reach some of the low-hanging fruit and the more sort of close to commercially viable projects. And perhaps that's the aim, but we still need solutions for the rest of the peat that needs to be restored. So the results from the previous models that I've shown show that private finance significantly increase costs. And as a result, projects need either higher carbon prices, significant de-risking by the government, or both. And we think that means that private finance could act as a sort of deterrent to people taking on peatland restoration. Instead, in the report, we've explored and modelled a new alternative model based on 3 key principles. One is public investment for public goods. So the Scottish Government would replace the current system of upfront grants with a new investment model based on zero interest income contingent loans. And that incorporates the second principle, which is sharing risks and rewards. So although the state would still cover 100% of upfront capital costs, there would be a new clawback mechanism, which means that projects pay back a small amount of the grant each year if or when future carbon credit sales make that affordable for the project. And we've also included a condition around community benefits to further share the rewards. The final principle is reducing uncertainty. So as part of this model, we're also adding annual operating payments for the first 15 years to be a source of stable income that mitigates against the risk of uncertain carbon markets and sort of protects landowners and managers in those early years before they can sell carbon credits. Now, we have modelled the cash flow of this example model, and how this would work is that the clawback and community benefits would be a percentage of net profit from the previous year, which means it would be after maintenance costs have already been taken into account. And any unpaid balance at the end of the project becomes a grant. And so for projects also not engaging in the carbon market, it would continue to be a grant. We think it provides a degree of risk sharing between projects and the state, with projects only paying back the loan if they're financially able to do so, with the loan reverting to a grant if they're not. In terms of cash flow, you can see it's obviously looking more positive than some of the previous examples. Even if loans are paid back and benefits are shared with communities, we've found that profits could still be higher for landowners than under a private finance-led approach, like the one we explored in previous slides. And that's due to the absence of paying investor returns at commercial rates. And although the repayments and community benefits look small here, over the course of 50 years, they do add up. So I'll say a little bit more about that in a moment. But in terms of some of our other findings, clearly finances are a really big part of this. But crucially, our report also found that meeting the peatland and woodland targets that Scottish Government currently has isn't only about money. So we identified a range of non-financial barriers that must be tackled to unlock restoration at scale. Now, many of these won't be new to you, I'm sure, as many of you work in this area, but they include things around uncertainty, and that's both related to future policy and regulatory frameworks, but also around carbon prices. There are well-documented gaps in skills and capacity for forestry and peatland work, and that has wider implications for things like rural housing and transport. There's also a lack of specific support for different ownership and governance models, which is a barrier. So research has identified that a lack of clarity over rights and responsibilities and benefits of selling carbon credits is a barrier for crofters and agricultural tenants, and more so potentially than a lack of funding. And other barriers include high deer densities, concentrated land ownership, and limited regulation. So our recommendations. The report includes quite a few recommendations, so I'll again briefly touch on them here, but I hope that you go and have a look after this webinar. We recommend, firstly, some things around our proposed alternative public investment model. So to recap, that's a zero interest income contingent loan model. And the idea of that is that it better shares risks and rewards between landowners and the public and adds annual operating payments to better support landowners and restoration. We think of this as sort of the government supporting and de-risking projects directly as opposed to sort of middlemen. More money stays in the local area and in Scotland, and so we think it's better aligned with the just transition principles. The project, the state, and the community could all be better off under this model than under private finance, according to our modelling. And essentially, we see it as a sort of better version of what currently exists, with the benefit of a clawback mechanism if the carbon market takes off, which is still an if, plus the provision of more support for landowners through operating payments. In terms of costs, our modelling explored the costs of restoring the remaining target peat area using the different investment models. We found that the maximum cost to the state is 40 million more per year for this model than compared to the status quo, so what's happening now. And the minimum cost is 34 million less. We found that just over half of all grants would need to be paid back for this model to cost no more to the Scottish Government than the current status quo. We also found that it could reduce upfront capital spending because a portion of the loans could be against the financial transactions budgets as opposed to capital budgets because of being a loan. We also found that landowners end up better off even with loan repayments and community benefit payments. So we think this model, while not the last word at all and can certainly be refined, is definitely worth exploring more fully. However, in addition to this, we're very clear that getting more peat restored revolves around changing and influencing landowner behaviour. And as well as carrots, we think there's a real role for sticks, and it's about finding the right balance. So a significant chunk of the report also looks at taxation. And although we explore various different models, in the end, we propose a green land value tax with a discount based on an energy performance certificate style rating for land. It would take time to develop the infrastructure for this. For example, land would need to be on the valuation roll, all land. And in the meantime, we think that there could be a role for a delayed degraded peatlands tax to be implemented relatively quickly and until a green land value tax could be brought in. So a delayed degraded peatland tax could be a signal that the Scottish Government is planning to bring in a tax in 10 years on degraded peatland to incentivise landowners to start taking action now. In addition to these, we also think that there needs to be a sort of suite of policy changes to address wider non-financial barriers. And these are things ranging from sort of changing land ownership and governance, so increasing public land acquisition and community ownership, to influencing how land is used in the public interest, so through the regulation of the land market. You know, many European countries have laws that influence or change the kind of use and management of land, and Scotland is an international outlier when it comes to regulating land, as many of you will know. We also have recommendations around strengthening skills, deer management, and support for different land tenures. And with these, it's mainly about tackling some of the barriers to progress, from increasing the workforce to providing tailored legal and financial support for different land tenures. And another one which we think, is key really is regulation of the carbon market. So globally, voluntary carbon markets have clearly had a rocky road in recent years. We've seen a boom which led to impacts on Scotland's land market, inflating land prices a couple of years ago. But we've also seen busts relating to sort of claims of greenwashing. The UK is actually seen as quite high integrity, but there are some other issues, including questions about the role of offsetting in our journey to net zero. What I mean by that is that I suppose we think that relying on private finance suggests that there's going to be a huge expansion in demand for these credits, but we can't rely on that demand and on offsetting only if we're going to meet net zero targets. And so there's a concern that focusing on that focuses time and resource into offsetting as opposed to avoiding or reducing emissions, which the Climate Change Committee have been really clear that we need to do more of. And we've seen countless times companies turning to carbon credits as a first resort over reducing their own emissions. So we think that it's important that there's stronger, more robust regulation of carbon markets, but that will have an impact on demand. So there's a conflict here around relying on carbon markets to reach net zero. In the report, we make a number of recommendations around regulation of carbon markets, including that the Scottish Government should commission an independent review to consider the appropriate role for carbon markets in delivery of a just transition, and also explore working with the UK Government to create a mandatory system of certification to ensure higher scrutiny. This has been a kind of whistle-stop tour of what's quite a detailed report. I've highlighted some of the recommendations, but there are many more in the report, so do have a look. The key points that I've tried to sort of bring out here are that the current model for peatland restoration has some shortcomings, but turning to private finance to fund peatland restoration, we think, and our modelling shows, adds risk and cost, which could deter restoration. We're recommending a new public-led approach, blending carrots and sticks and finding the right balance of those to change and influence landowner behaviour. And that incorporates a zero-interest income contingent loan model, replacing non-domestic rates with a green land value tax, including discounts based on an energy performance certificate style rating for land, and a delayed degraded peatlands tax to act as a more immediate measure in the interim. The report makes a series of wider recommendations, which I've explained some of. But yeah, I'd encourage you to take a look, and we'd be really keen to engage with folk off the back of this on some of our recommendations. So I'll hand over to Laurie now to wrap up and then open up to Q&A.
Okay, thanks very much, Hannah. So we're very aware that we have bombarded you with a lot of information there, and as Hannah said, that was a bit of a whistle-stop tour. Definitely check out the report, and there's a lot more detail in there. But we wanted to leave plenty of time for questions or for comments. As I say, we don't think by any stretch of the imagination we have solved this. This is just our effort at trying to make a useful contribution to the debate, and there are many areas that need further thinking, refinement, etc. So please do feel free if you have questions to pop them into the Q&A box, and then Hannah and I will do our best to respond. Even if it doesn't need to be a specific question, it can be a comment that we can then discuss. But I'm conscious we have nearly 60 people on the call, and I know we've got a huge amount of experience and expertise. So yeah, do fire in any questions or comments. Okay, so we have a few coming in. Let me just. Okay, we've got a few, so I'll maybe try and group some of these together. Okay, so given the desire to increase the pace and scale of restoration, is the loan model attractive enough for landowners to commit to, given the complexities and perception of entering into a loan? And does the modelling account for loan being expensive to operate for government? So This is a really good question. I can kick off and then hand over to Hannah. Um, so a key question as to whether or not something's going to work is the extent to which it is attractive to landowners when the incentives are there. And clearly, under the status quo, the current system isn't attractive enough. And one issue that the reason that we do think private finance isn't necessarily going to work is that at the moment there is a grant system. So landowners can get grants, essentially free money. Even under that system, with free money available, it's not happening on the scale and pace needed. And so we're unclear why replacing grants with, say, a loan at 10% is going to actually incentivize restoration. In practice, it probably actually deter it because all of a sudden you're in a debt contract, you have to pay out 10% returns. And so, yeah, the move from a grant to a loan, a 10% interest loan would seem to deter it. I think your question relates to, is our loan model attractive enough? And so, absolutely right, and that what we're recommending is a shift away from just upfront grants to loans. The difference is that with our loans is there's 0%, so there's no returns that need to be paid. And B, they're income contingent, meaning they're only repaid if the project is in a financial position to do so. In other words, if there is profits being generated from the carbon market. If there isn't, then there's no repayments made. And as Hannah said, ultimately any outstanding balance will get written off. So it works kind of like student loans work, albeit with zero interest. Now, if it was just that alone, the switch from the upfront grants to our loan model, um, that probably wouldn't be appealing enough for landowners because it still involves going from a grant to a loan. I think this is the reason why we introduced the ongoing operating payment, which is an annual grant to cover maintenance costs over the course of the initial 15 years of the project. And I think that is a big difference because one of the issues that Hannah mentioned with the current system is this uncertainty. There's a lot of uncertainty around, okay, well, what's going to happen to carbon credits? Am I going to be able to generate revenue or whatever? And there's a big question mark there. But to have guaranteed annual grants covering maintenance costs, as well as having this sort of risk sharing mechanism where, yes, it is an income contingent loan, but you're not going to be forced to pay it back unless you can afford to. Whereas if you enter a commercial debt contract, it doesn't matter what's happening to your finances, you still have to pay that back, otherwise you risk defaulting. So yeah, I think we've tried to strike that balance. Clearly, there's more things to be done there. We are looking to do more engagement on this with landowners and with developers and other stakeholders, because no doubt it can be refined. Hannah, do you want to add anything else on that?
No, I'm happy with that. Thanks, Laurie.
Okay, next question. Have you undertaken a sensitivity analysis around the projected price of carbon and at what price this could generate positive revenue flows, i.e., what's the tipping point price? So, Hannah, I'll maybe let you answer that. Just to say as well, if you are comfortable, when you say a question, do say who you are and where you're from as well, just so we can refer to that. But yeah, no, that's a really good question, Hannah.
Yeah, thanks. I'm not going to go into loads of detail because I don't have the numbers to hand, but we do this in the report to a certain extent and do show what the sort of break-even price would need to be. And for some of them, we find that carbon prices would have to be, over 50% higher than they already, are, or than they are in the assumptions in the model to even sort of break even. And so that is included in the report, and I would encourage you to have a look at that. What it shows is that, yeah, especially for the de-risking model, we would need to be seeing a kind of like meteoric rise in carbon prices. And as Laurie explained, for various reasons, because of the demand for peatland credits being significantly lower, we just can't really quite see the carbon market getting there, which is why I think that there are sort of key issues around those models.
Yeah, exactly. I think, and that's it's a really good point, and something we did try to do is look at that break-even point almost for each model. And certainly our model, the break-even point for our model was significantly lower than all private finance approaches. Um,
Laurie, I
okay,
was wondering if you would like to answer. There's a question here. You mentioned private investment does have a role to play. What is it in your view?
yeah, absolutely. So what I was referring to there is our overall net zero journey. So if we're going to deliver a just transition to net zero, more than anything else, that's going to rely on whether we can mobilize investment in scaling up green industries, green infrastructure, green technologies, but also decarbonizing existing sectors. And there's a huge role both for public investment and private investment in doing that. And in terms of the role I was saying there is we're not going to get to net zero without mobilizing quite a lot of private investment across different areas of the economy. And so the point I was making there is just that we're not trying to say an overall net zero private investment isn't important. It is really important. It's just that we need to look in different areas of the economy, look at, okay, where can the private sector lead? Where can private finance fund this? And actually, where is this going to struggle? And in this area, because of the various aspects I mentioned earlier in terms of the economics of nature, um, in our view anyway, this is an area where, at least if we sit back, private finance isn't going to deal with it. And so yeah, in relation to most areas of the economy, we absolutely need private finance to be playing a very, very significant role. In this specific area, though, for the reasons Hannah outlined, trying to bring it or where it doesn't really fit and trying to come up with mechanisms to kind of make it fit and can end up pushing up costs, and ultimately potentially deterring investment. So yeah, I think we need private finance in lots and lots of areas. So it's really just to make the point that we're certainly not against a private finance or private investment by any stretch of the imagination. And the other point, just to reiterate what I said earlier, is obviously there are lots of different types of private finance. And I mentioned earlier, like philanthropy has a really important role to play, and that needs to continue. It can't be relied on. There are obviously other types of investors in terms of sort of impact investors and social impact funds who aren't necessarily targeting a commercial rate of return, who might be happy to actually earn, not a double-digit return. And that's fine in our view. If there are investors out there who are keen to do this and aren't that fussed about returns, we're definitely not against that. I suppose what our analysis is showing is that if we're talking about the sort of mainstream commercial finance, the institutional investors who, they've got capital to invest, they're looking for 10, 11% return. If nature can't provide that, they're not going to be interested. And so trying to sort of jump through hoops to come up with complex de-risking mechanisms to kind of generate that return, that can end up pushing up costs in all the way that we've just said and be more risky and expensive to the state, if that makes sense. So yeah, I hope that kind of answers your question, but do feel to follow up if not. Okay, next question. What would be the incentive for landowners to sell carbon units if the proceeds go towards repaying the loan? Hannah, do you want to?
Yeah, thanks. There's a few questions in the chat around this, and thanks. I think they're really important questions that can help us refine the model. Um, there's also an issue which we've been talking about internally about if landowners are just wanting to keep the credits for their own insetting purposes. And if we're using profit as the main motive that landowners would be engaging in this, then I do think we might need to adjust the kind of balance of how much of the loan they're paying back versus how much they're keeping. But in our modelling, we do find even paying back a fair amount of the loan over time, they'd still be making a profit. So those things can sort of be fine-tuned. But I think the main thing that I want to say around this is that we're talking about finding the right balance of carrots and sticks. Like, we think it's quite unlikely that we can just incentivize landowners to do this through promising increasing returns or free money. And actually, a key part of this for us is about trying to find the right balance, and the right role that taxation can play in this as well. And we're kind of the view that, we need to encourage landowners to change their behaviour and to try to figure out the right incentive structure around that. And bringing in tax is really important. And if landowners decide that restoring their peat isn't something that they want to or can do, then we're okay with the idea that people will sell up to somebody else who is able to and interested in doing that. So yeah, definitely there are areas around the model that can be fine-tuned to think about that balance of incentives and to avoid some of the kind of, potential like loopholes. But I think key for us is that it's not just about this model, it's also about changing the balance of, carrots and sticks and reducing all the other barriers to doing this work.
And maybe just one extra thing to stress there is, in terms of what's the incentive to do this, we're absolutely not saying that 100, like in a year, all of the profit made has to go back to repaying this loan. And so in the report, I think we we make an assumption that the project would keep two-thirds of any profits, and say a third would go towards both repaying the loan and sharing community benefits. That's an arbitrary assumption, and so there clearly is still there needs to be a monetary incentive for landowners to do this, and the question of what's the balance between how profits are shared between the different stakeholders of the landowner, the government, and the community. That's up for debate. That was just an assumption that we made. But clearly, I definitely agree that for the incentive to be there, the landowner would need to be able to retain, the majority of the profit made. Otherwise, they're not going to do it. And as Hannah said, I think the key thing is even with the sharing, the repayment, and the sharing with communities, the profit for the landowner is still significantly more than would be the case had it been commercial private finance, because they'd be having to pay 10% returns out the door every year, which would just completely eliminate the profit and likely turn them into negative cash flow. So, yeah, I think there's one here which I think it's maybe worth touching on. Hannah touched on this briefly, but does your modelling allow for the cost of government borrowing for the zero interest arrangements? So, yeah, the question I think touches on the broad question of how would this be, how would this be funded? And one thing that's quite interesting is that when the Scottish government gets its budget each year, which we'll see in January, there's three different types of budget. There's resource spending, which is day-to-day spending on the day-to-day running costs of things. There's capital spending, which is investment in infrastructure. And at the moment, peatland grants come under capital spending, and capital spending is under a lot of pressure. There's also something called financial transactions, and this is what we get through the Barnett formula from the UK government. And the difference with financial transactions is these can't be spent. The budget for financial transactions has to be lent in the form of loans or equity investments. And that is separate from day-to-day budgets and separate from capital budgets. But what we are seeing, although the public finances are very tight and we're expecting the budget to reflect that in January, the Scottish Government's budget for financial transactions is expected to go up quite a bit. And this is because the UK Labour government has decided to make a lot more use of financial transactions through things like GB Energy and the National Wealth Fund. They've set up these institutions. They're going out making loans and investments. That has consequentials through the Barnett formula for Scotland. And so I think we're looking at a situation where, although the day-to-day budgets and capital budgets are tight, financial transactions are actually looking pretty healthy, which means we've got budget to use there. And in our view, this would be a really good way of how to use these financial transactions through these 0% income contingent loans. Clearly, if not all of these are going to be repaid, and we don't expect all of it to be repaid unless the carbon market really takes off, some of it would need to be written off, and that would draw on capital budgets. But because all of the peatland grant funding currently comes from capital budgets, shifting out of that into the financial transactions would actually free up a chunk of capital spending, which is extremely strained. And so, yeah, we think there is scope. Obviously, needs further investigation. The other thing to mention here is we talk about in the report, could the Scottish National Investment Bank play a role as the provider of these zero interest and contingent loans? It's been set up with a clear just transition mission. It has capital to invest. It obviously has the expertise in finance. Could that be the body that actually provides these loans? That's something that can be sort of discussed and thought about in more detail. We don't have a firm view on that. That needs more examination. Okay. I'm just trying to see. We've got a lot of questions. Okay, yeah, I think this is maybe hand this to you, Hannah. Great report, really interesting recommendations, which I would largely support. The premise of the report is around meeting targets for woodland and peatland. Is there space to look at how modelling of different funding and finance levers can enable ecological restoration, including ecosystem health and the restoration of natural processes? Yeah, good question. As I said at the start, we did focus on woodlands and peatlands, but yeah, Hannah, I don't know if you want to respond to that one.
Yeah, I mean, the focus of the report was woodlands and peatlands, and I suppose specifically looking at sort of thinking about things from a sort of carbon lens, obviously through focusing on the carbon market as part of our analysis. Obviously, there's much wider both benefits of wider nature restoration and also wider elements of nature restoration that unfortunately we didn't have the scope to consider in this report. But I do definitely think that there are a couple of questions in the chat also about whether our findings would hold or be useful or interesting for the emerging kind of conversation around biodiversity markets and credits. And I think that while that hasn't been the focus of the work, there are certainly elements that could be transferred across, and we'd be really interested to sort of chat to people and think about future work on that going forward. I don't know if you've got wider thoughts on that, Laurie.
Yeah, no, I think there's a few questions on the biodiversity credit side of things. It's certainly something we'd be really interested to explore. I mean, we do have a sort of box case study on this in our report, just recognizing this is an emerging area and sort of signposting it. And there have been some concerns raised about sort of biodiversity credits from various people. And I suppose we would urge a bit of caution here in that many of the issues, carbon credits is the main area that's come first in relation to this and these sort of payments for ecosystem services. As far as we're concerned, there's still quite a lot of issues with that. It's not quite working necessarily in the way that we think it should. As Hannah said, we are seeing actors in the economy resorting to offsetting as a first resort rather than a last resort as it should be. And so I think before sort of rushing into some of these other mechanisms, it's important to think through some of the finer details. And I know the Scottish Government is doing that, and that's something we'll be looking to engage on. But just for capacity purposes, we really had to kind of limit the scope of this to woodlands and peatlands. There's also just the elephant in the room of agriculture and agricultural subsidies, which is hugely important. And in terms of sums of money, absolutely dwarfs anything in relation to woodlands and peatlands. That's also something that we sort of acknowledge in the report. We've not had a chance to look at that, but clearly that also needs to be looked in the round on this because I think we can't continue to ignore that, as I say, elephant in the room for much longer.
Um,
Um,
there's
sorry.
loads of other really fantastic questions, but I'm just really conscious of time. And so maybe we should think about wrapping up at this point, but unless there's any other burning questions you want to answer quickly, Laurie. But yeah, really keen to continue these conversations, and we'll be sending out ways to keep in touch with us as well.
Yeah, definitely. And yeah, sorry, we've kind of we are running out of time. There's loads of good questions here, but as Hannah said, we're really keen that this is the sort of start of engagement and conversation. It's something that we're hoping to continue to work on for sure. And so we are keen to speak and hear others' thoughts. We are going to be sort of trying to refine their proposal, but also do a bit more engagement. I think someone's got a question here about how do we involve communities. I think there's a bit of work to be done in the sort of engagement around communities, but also landowners, developers, etc., to really get thoughts on this. And so, yeah, we're really keen that this is just the sort of the first step. Um, but as we're approaching the end, we just want to thank everyone for taking the time. Really appreciate it. We will follow up with an email after this at some point, probably this week, just sort of, yeah, again, thanking everyone and sharing a link to the report, etc. If you are interested in discussing further with us, do drop us an email and reply to that, and we'll certainly be keen to have discussions because there's lots of things that have come up here that we just haven't had a chance to get into. If you are interested in following our work, Holly has just shared in the chat link to our website and social media channels on X, Blue Sky, LinkedIn, Instagram. There's also the YouTube link there. So this whole presentation and session will be up on our YouTube channel, hopefully fairly soon this week. And so if there's anything that you didn't quite catch in the presentation or whatever, you will be able to go through and watch that back. So do keep an eye out for that. And finally, we do have a newsletter, which Holly has put the link to there in the chat, which we send out quarterly, which just sort of shares updates on all aspects of our work, not just on nature, but other areas. And so if you're interested in staying in touch, do sign up to that. It's a useful way to stay up to date. But yeah, I think anything else you want to cover, Hannah?
There was just one question about sharing the slides, which we can also do.
Yeah, we can add that to the email when we follow up with everyone afterwards. So, okay, cool. Well, thank you very much, everyone. Really appreciate you taking the time. Thank you.
Thanks. Bye.